Today on the HopeFilled Financial Podcast, to get things started, I'm going to tell you how this clip of Will Smith changed my life. And the takeaway from my story is going to tie right into the main topic. How risky is the stock market actually, and can you trust it with your financial future? Good morning and welcome to the HopeFilled Financial Podcast. My name is Jay Disberger, your one and only HopeFilled Financial Coach, and I'm happy that you're here with us today. As promised in the intro, we're going to be reacting to a particularly inspiring clip featuring Will Smith. All right, the year is 2017. I'm still in school. I'm about a year away from graduating. I am not dating anyone at this point. I have met Amanda. We met in 2016. We had talked about dating before, and it was actually my idea that we don't date. So that's kind of where our friendship was. We were just friends, and she invited me to her birthday party in April. And hanging out that day on her birthday without going into too much of a tangent sort of made me start thinking we should talk about this whole dating thing again. So I brought it up to her that following Monday at Bible study, and she was spending some time thinking about it. Should I or should I not consider dating Jay? I should give him an answer. We can either stay friends, or we can try this dating thing and see what comes out of it. She felt frustrated that it was taking a whole month to think about this. Unbeknownst to me, I, who had just asked and was waiting patiently, wasn't really in too much of a rush for an answer. To be completely transparent, I was very focused on wrapping up school for the year and getting ready for my internship in Salt Lake City. But sometime in April, I can't remember exactly when, I found this video of Will Smith, and I watched it. And we'll watch it here in a moment. It was interesting. So I just simply shared it with all my friends on Facebook. I thought it was good. I saw Amanda liked it. What I didn't know at the time is it had a profound impact on her, because part of her reflection on dating was getting over fear about dating, fear about what this decision could lead to. Would it lead to marriage? Would it lead to a breakup? Would it lead to heartbreak? Would it lead to a difficult relationship? Would it lead into a happy relationship? It's really hard to know this early on. And she was trying to figure those answers out. Watching this video inspired her to give herself a deadline, though, basically saying, I'm going to make a decision by this date. And oddly enough, this date that she set for herself was May 4th. Star Wars Day, May the 4th be with you. I think that day just transpired for when this is scheduled to come out if we are staying on track with time despite the craziness of life right now with a newborn. Before we jump into the clip with Will Smith, it was the 3rd of May, and Amanda had a adoration hour, a prayer hour that evening. And it was late. It was like 11 to midnight. I was on campus. I was writing my thesis at the time. And she texted me and said, hey, do you want to go pray with me for an hour? And I was, yeah, sure, we can go. I didn't realize what she was praying about, but she was really, let's just say, in deep prayer. She was shaking. She looked like she was a little anxious. After the fact, she asked me what I prayed about. I can't remember what it was. It was something very surface level, something that probably didn't matter that much. I mean, I didn't do much to prep for going to pray. She asked me that day. She dropped me back off at campus right after midnight, after prayer was over. So it was the very, very beginning of May 4th. And she told me that the thing she prayed about was whether or not she should date me. And the feeling that she got, the message that she got was very clear. She said, I am called to say yes to dating you. I have a calling to love you. I was completely speechless and didn't end up going back to work on my thesis that evening. I grabbed my backpack, went to my car in the parking garage, went home, even though I was in the habit of staying up till 2 or 3 a.m. working in this season of life. Now, you should know, I lived from home when I was going to college. I lived in my parents' basement.
With these morons who live in their mother's basement.
So I got up relatively early the next morning to go to school. I was going to grab breakfast. My parents were at the table, and it is so unfair. I turned the corner, and apparently just the way I was carrying myself, just the way I was smiling, just the way I was walking, my mom took a sip of coffee, turned, took one glance at me, and goes, you got a girlfriend, don't you? I don't know how my mom knew, but moms are gifted. So without further delay, we're going to listen now to the video that I shared on Facebook that inspired Amanda to give herself a deadline to say whether or not she was or wasn't going to date me.
Drink with your friends, and somebody says, yeah, we should go skydiving tomorrow. And you go, yeah, we'll go skydiving tomorrow. Yeah, yeah. And you go, yeah. And everybody goes, yeah. So then that night you're laying in your bed and you just keep, and you're terrified. You keep imagining over and over again jumping out of an airplane, and you can't figure out why you would do that.
This reminds me that anxiety can be defined as experiencing failure in advance of that failure. I think it would be absolutely terrifying to jump out of a plane, and naturally the fear is that things go wrong. So all the anxiety leading up to skydiving for the first time, to my understanding, has to be fear that something goes wrong and experiencing it over and over and over.
You wake up the next day and you go, down and you say where you were going to meet and everybody's there. So you get in the van and you're like, oh my God. And your stomach is terrible. You can't eat and everything, but you don't want to be the only punk who doesn't jump out of this airplane. So you fly and you go up to 14,000 feet, and somebody opens the door. And in that moment, you realize you've never been in a freaking airplane with the door open, and you're looking out down to death.
All right, his fear and anxiety is highlighted by the way he describes looking out of the airplane window. You're looking down at death.
And they say, on 3. And they say, 1, 2. And he pushes you on 2 because people grab on 3. And you go, Arr! And you fall out of the airplane. And in 1 second, you realize that it's the most blissful experience of your life. You're flying. There's zero fear. You realize that the point of maximum danger is the point of minimum fear. It's bliss.
And so for Will Smith here, he experienced more anxiety and fear leading up to jumping out of the plane than he did once he got out the plane door.
Why were you scared in your bed the night before? What do you need that fear for? Everything up to the stepping out, there's actually no reason to be scared. It only just ruins your day. The best things in life on the other side of terror.
I want to point out that that clunky line there was cut in an awkward way because Will Smith in the original interview actually says that
God placed the best things in life on the other side of terror.
On the other side of false evidence appearing real. And despite your feelings on Will Smith, despite your feelings on this message, there is a good point to be had, which is the anxiety of experiencing fear leading up to a major event, leading up to something that you are scared of, does nothing but take away from your present leading up to that point. So that was the Will Smith video that I shared on Facebook that did indeed have a major role in changing my life. Through the lesson, Amanda was able to give herself a deadline to basically make a jump for something that was causing her anxiety and fear, considering a dating relationship with me. There's something, though, in the world of finance that can cause us a lot of anxiety and fear if we haven't engaged with it before. And that's going to be investing, particularly in something as volatile as the stock market. And it really does beg the question, how safe is the stock market actually? And from the historical perspective, that's what we're going to be covering in today's main topic. For today's main topic, we're going to be digging through a spreadsheet that I built as an exercise for myself about a year ago. And here was the inspiration. Dave Ramsey gets a lot of grief for telling listeners that you can easily average 12% rate of return in your retirement portfolio.
12.2 average annual return that has an average annual return of 12%. On the show, you said that the stock market has averaged around 12% a year.
Now, many of Dave's critics say, Dave, you can't take a simple average for rate of return and use it to project growth. By the nature of the market being volatile, you have to use what's known as an annualized rate of return, or a geometric rate of return if we're going to use a mathematical term. Basically, the difference is this. A simple average is what you learned in middle school. You add up, say, 3 numbers and divide by 3. That gives you the mean. It gives you the average. It's simple. It's easy. The geometric would be saying, okay, let's look at what happened to the stock market in reality and graph it up to this point. Now, it's volatile. It's got a whole bunch of wiggles. Here's where it ended. If I were to go to a retirement calculator and plug in a flat, steady rate of return that's nice and smooth, what rate of return is going to get me with the same investment, be it an initial one or one that's spaced out over time, what's going to get me to that same point on the graph? It's going to be different than the simple average in most cases. Now, before I show you the graph, I need to set up at least one more point, and that is when you're taking a geometric average, an annualized average, it has to be annualized over a particular window of time, a particular time horizon for history. And you need to say this is the geometric average for 5 years or 10 years or 20 years. And there's good old-fashioned wisdom that you're not supposed to go out timing the market, because attempts to time the market typically have day traders losing money. Instead of trying to time the market, you want to have time in the market. Have a long-term buy and hold strategy. That's the general wisdom you're going to get from almost every financial advisor. So what I did last year is I broke up the S&P 500's return into 1, 3, 5, 10, 20, and 30-year time periods to see not only what the average geometric growth was for these different time periods, but also what is the maximum and the minimum I can expect if I invest for at least 5, 10, 20, or even 30 years. So with that, let's talk about this slightly intimidating looking graph. Okay, the most volatile series on the graph here is going to be represented by the blue dots. There is one dot per month from 1991 all the way through to, I think, March of 2023. The blue represents the year-to-year annualized average, which is basically just what did the stock market do for each of these years. And up here in the summary, you can see that we have a minimum of negative 43.3%, an average of 11.4%. And that's going to be Dave Ramsey's simple average that's close-ish to 12. Again, this is the S&P 500. Dave claims that you can beat that. And then the maximum rate of return that was seen was 56.3%. And the standard deviation is a whopping 16.5% year to year. That's a lot. Okay, it looks like the maximum return from the time period I looked at happened not too long ago. And for the minimum rate of return, which again was a negative 43.3%, that's the worst year from the 2008 housing crash. Okay, the next series we're going to talk about is going to be the green dots on the graph. These represent the 3-year geometric return moving through time. And you'll notice that the green dots don't start at the beginning with the blue dots on the graph. That's because, well, data can only be recorded after 3 years of the data has transpired to say what the geometric average was for a 3-year time frame. So as we go through these graphs, they're going to become shorter and shorter and shorter as the time frames get longer and longer. Now, what's really interesting about this is just going to a 3-year geometric average really smooths out the volatility quite a bit. There are still 2 big parts of the graph that dip negative. One of them is going to be over here shortly after the 2000 started, and the other one is going to be the later portion of the 2008 housing crash. But if we look over here, instead of the minimum rate of return being 43.3%, it's now 16.2, negative 16.2. The average is 10.5% for the rate of return with all the 3-year periods, going from 1994 up to the 2023. And then the maximum is 32.7%. Now, this is the maximum for month-to-month periods. Again, each green dot on the graph represents a single month after 3 years of data have transpired. Okay, let's talk about the orange dots with the little blue outline to them. Those are going to be the 5-year rolling periods. Similarly to the 3-year geometric averages, the 5-year annualized returns still dip negative in 2 points during this time frame, but the volatility is really smoothed out. The minimum annualized rate of return over the 5-year periods is now negative 6.7%. Meanwhile, the average is 10.1, not a lot of change there, and the maximum is 28.7%. So here's the behavior I've seen so far from 1 to 3-year periods. The minimum annualized growth is coming up closer to 0. It's becoming less negative, and the maximum growth is slowly becoming more realistic, less extreme than that massive 56.3% we saw for the 1 year. But the average so far has centered nicely around the same point. So the next series we're going to talk about is the 10-year one. It's the bright yellow dots that I have on the graph. For the 10-year annualized returns, I think we've gotten away from the first major dip, and now we only see one during the 2008 housing crash, where the 10-year annualized returns dipped negative. Now, this is something that I teased in last week's episode when I was doing my review of Dave Ramsey's Foundations curriculum for homeschoolers, the class that I took. There were statistics in there right before the housing crash that said something like 97% of all 5-year periods in the stock market made money, and 100% of 10-year periods made money. What I'm showing right here is contrary to that. Now, I know that the book I reviewed was published in 2008, but I'm pretty sure there are other points in history when the 10-year rolling annualized average dips negative. And for you, that means that there is no guarantee that for a 10-year period of time, you will make money in your investment. It is likely, it becomes more statistically likely looking at the historical data than otherwise, and definitely more likely that you're going to make money in the long run than you would the short run, but it isn't a guarantee. And this is as good a time as any to say that this does not constitute financial advice and that historical rates of return are no guarantee of future rates of return. It can simply inform us, educationally speaking, about how the market has performed in the past. With that, let's look at the statistics. For the minimum here, we have negative 3.5% for the smallest geometric average in a 10-year period. The average has plummeted quite a bit, down to 8.4%, but the maximum still rests at 17.3%. And one reason why this average may suffer compared to the previous ones is because in the data set that I used, the yellow dots, the 10-year annualized returns, begin right after the dot-com bubble burst. So there's a whole lot of high numbers that can boost the average for the previously covered annualized averages that the 10-year here doesn't seem to get. With that, we're going to jump forward to these gray dots. These represent the 20-year rolling annualized average returns. And this is the first data set that we have that does not dip negative. In fact, the minimum growth for this is 4.7 and the average is 7.9. And the maximum is only 9.9%. The standard deviation is 1.2%. The standard deviation shrinking so much from what the 1 year was represents the fact that volatility in the long run starts to disappear. And this is pretty obvious looking at the gray dots. They basically make a line, a flat line that lives just underneath the 10% annualized average. And that leads us to the light orange dots right here at the end. Now, there's only 2 to 3 years worth of dots on the graph now for the 30-year annualized average. That means from a statistical significance perspective, this data for the 30-year rolling annualized averages is the least informative. What I find really interesting is that it lives between the 20 and the 10-year dots. It's above the gray dots and below the yellow dots. And that's further emphasized over here in the summary where you can see that the minimum 30-year annualized return is 9.4%. The average is 10.2%, and the maximum is 10.8%. And the standard deviation is only 0.4%, meaning that from a historical perspective, 30-year annualized returns are very stable. And while this is still interesting and worth sharing with you for educational purposes, I want to again reiterate that the 30-year annualized average data is a very small data set. If you want to see me run this exercise again in a future episode where all 1 to 30-year periods span the entire length of the graph, please let me know. I will rework this with more historical data if I can dig it up. So let's take a step back from the data and think about what this really means in the context of Dave's claim of 12% returns. We can see the simple average for the S&P 500 that Dave sometimes puts in the fine print saying that the S&P 500 or the stock market will get somewhere between 11 and 12%, depending on which of Dave's material you're looking at. Dave claims that you can beat this, so 12% is not unrealistic. However, we have also seen that the critics have a very good point, saying that the simple average for 1 year periods does not translate to geometric or annualized returns, as those are suppressed due to volatility. And we can realistically look at an annualized return over a longer period of time if we are wanting to analyze historical data. And the longer the annualized period is, the more stable the return appears to be. The lower the standard deviation becomes, the higher the minimum rate of return is, and the lower the maximum rate of return is. They tend and trend toward an average that many experts will tell you is much more realistic to use if you're trying to do a long-term stock market projection for the growth of your nest egg. But we only looked at the S&P 500. We only looked at the stock market. We didn't look at any of those super aggressive mutual funds that Dave Ramsey talks about being able to beat the market. So I thought it would be fun to also run this exercise with my 401k as I invest relatively aggressively. So here we are once again in another graph. This time, instead of representing the S&P 500, we are looking at my 401k. And you should know that the 401k growth here has been corrected for the expense ratio that has been applied, as the expense ratio is not negligible with the aggressively invested 401k that I have. So looking at the blue 1 year rolling rate of return, you can see that it's much more volatile than the S&P 500 graph was. It's got much more wiggles, it's got higher peaks and deeper valleys. In fact, if you look over here, you're going to see a negative 47.9% minimum, a 14.4% simple average. So yeah, we did beat the simple average of the S&P 500. The maximum that we see here is 85.6%, and the standard deviation is 22.8%. Basically, this trend continues for all the different series. If you're watching the video version of the podcast on YouTube or Rumble, I'm going to read down the summary statistics as you enjoy looking at the graph and thinking about the differences. So for 3-year periods, we have a minimum of negative 28.1%, an average of 12.7%, a maximum of 44.4%, and a standard deviation of 12.3%. Just 3 years has really tightened things up quite a bit. Moving on to 5-year periods, the minimum is now negative 11.4%, the average is now 11.9%, the maximum is 35.5%, and the standard deviation has finally gotten below 10%, it's 9.7%. Here's where it gets interesting again. For the 10-year annualized averages, we have a minimum of negative 4.1%, an average of 9.8%, below 10%, a maximum of 21.9%, and a standard deviation of 5.7%, less than 6%. Just like the S&P 500 for 20-year periods, we now don't have a negative minimum. For the annualized rate of return here, it's now 5.1%. For the mean, the average, it's 9.3%. For the maximum, it's 13.3%, which does indeed exceed Dave Ramsey's 12%. And then the standard deviation is 1.5%. So we're really honing in on something that is almost predictable. Lastly, for the 30-year periods, which again is a much smaller data set and not near as statistically significant as the others, we have a minimum of 11.1%, an average of 12.3%, and a maximum of 13.2%, with the standard deviation that is 0.7%, which is interesting because it's about double the standard deviation of the S&P 500 for a 30-year time frame. Remember, that was 0.4% compared to, again, 0.7%. So what does this mean? Is Dave Ramsey right that you can get 12% rate of return and beat the stock market? Well, in hindsight, you can find anything that beat the stock market with the right mix of stuff. We're even saying that you move things around, but we don't have hindsight. And I think it's very risky to say, let's go with the averages. As you saw, the minimums for all series, my 401k and the S&P 500 for 30, 20, and 10-year time horizons fell below that magical 12%. So it's easily possible that someone doesn't average 12%, but it's easily possible that someone could. Dave Ramsey may be experiencing some survivorship bias when he is saying 12%, because he claims that he has something on the order of 13 to 14% for his particular season of life for his retirement funds. And that is not an unbelievable claim. It's quite possible, looking at the data that I have here, that he's actually experienced that. Historically speaking, and again, this isn't financial advice, refer to the description for the full disclaimer, we can see that the longer you're invested in the stock market, the more time you have in the stock market, the more predictable it becomes. The more predictable it becomes that you will have a consistent gain, something that is stable. Meanwhile, for the short term, it's all over the place. So if you're going to invest for the short run and try to get return in a very short period of time, the stock market might not be a good, safe place for your money. And this is why it's unwise to take your emergency fund and invest it in the stock market. Because right when you need it most, it could be in the middle of a dip. We could be going through another 2008. There's a lot of fear that there's going to be volatility here in the future. And I certainly don't want my emergency fund that I might need within the next 3 to 5 years flopping on the floor like that. Meanwhile, retirement is a long ways off for me. I still have another 30 years personally until I'm going to be able to access my retirement accounts. Through this exercise, assuming historical trends hold true, I can see some sort of emotional confidence that I will experience a gain by investing in the stock market in the long run, in 10-year periods or more. It is not guaranteed, and I don't want to sugarcoat it. You need to know that there is no guarantee that you will make a gain on any type of investment that you make. But historically speaking, there is statistical evidence that shows that we can have some level of confidence that our investments are going to have a gain. Otherwise, we wouldn't have accounts where any of us can go and invest. We wouldn't have 403Bs, we wouldn't have 401Ks, we wouldn't have IRAs, Roth and traditional alike, where the conventional wisdom that experts give us is to put our money in there with the expectation it'll grow to something more than it otherwise would be, so we can retire with dignity. And if the volatility in the stock market, the roller coaster, is causing you fear and anxiety and robbing you of your today and preventing you from taking the leap and getting into the investing game, well, maybe this historical perspective, this exercise can give you a more educated way to think about it so that you don't have anxiety stealing your day to day, and you can move forward with conventional wisdom to invest for your future as is appropriate for your circumstance. And with that, I want to know what you think. Do you think that this exercise, looking at geometric or annualized returns for different time periods, was useful? What does it mean to you? And what kind of ways would you like me to revise this exercise for future episodes? I look forward to hearing what you have to share. And with that, until next week, until next Tuesday, budget bravely and enjoy your hope-filled financial future.